I say within, by the second quarter of next year, I'm looking for one last leg of the rally, taking gold as high as 2,022.50. That's my target.
I'm looking at the price of gold this week. We're speaking on Wednesday. Hasn't moved at all on the news. Doesn't seem to me that the gold market really cares about rates going past neutral, which when you think about it should be very bearish news.
Well, I do think that that's highly on the mind of market participants. However, when we're looking at raising rates very nominally, I mean, we had them flatlined up until March, raised it 0.25%. Last FOMC meeting, they went to a 0.5% rate hike. That's not a big jump in interest. Now, the big thing is dollar strength, and that has been pressuring gold to a great extent. But I think that basically the market questions whether or not, as you just brought up, the Fed will actually act on what they say they intend to do.
Okay. I've asked you this before, the concept of a gold winter. It's a term I kind of derived from the crypto space. They called it crypto winter when Bitcoin went down and stayed flat. Well, we saw something similar happen with gold. Post 2011, we had the price come down from $2,000 all the way down to $1,200, stayed around $1,200, $1,300 for a number of years, Gary, before it finally went up in 2019. And people are concerned now that the same thing is going to happen. We haven't gone down, obviously, to $1,200, but we've been stuck in a range between $1,800, $1,900 for quite some time. We've reached $2,000 twice this year, but it didn't stay at that level for very long. So, Gary, my question is, do you see this consolidation pattern around $1,800, $1,900 lasting several years like the last cycle?
Well, I think that anytime you have a multi-year rally, the correction will also be a multi-year decline. However, there's a really big difference between what we witnessed middle of 2011 when gold peaked at 1920 and then began to come down. For what, about 3 years, it traded between 1800 and 1537, back and forth. And this occurred as quantitative easing was going through Q1, Q2, Q3, Operation Twist. And when they ended quantitative easing completely, that's when we broke below $1,500 per ounce. And it slowly declined for another couple of years. It actually hit a low, of 1,020 at the end of 2015, beginning of 2016. I really see the rally that we're at a tail end of now, beginning in 2016, when gold bottomed at $1,000. So when we look at relative price at 1,800, it hasn't really gone down that much, considering what we saw last time when quantitative easing came to an end. We had a dramatic move to the downside. Right now, they've stopped accumulating assets, and now they're beginning to not taper, but reduce the balance sheet. And I think the reaction we're seeing is absolutely muted when compared to the last occasion in which the government itself pumped liquidity into the market and took it away.
This should, again, be bearish news for gold. Gold is holding quite steady. What is the gold market signaling? Is the gold market signaling to you, Gary, that maybe Biden's plans of fixing inflation will not be successful? Because, again, it should be bearish news. We should see gold fall.
I think that the scenario we have right now is interesting in that the perception, market sentiment acknowledges that it's going to be difficult at best and will probably not have a major impact on reducing the level of inflation. The second thing is that market sentiment is acknowledging that all branches of the government, whether it's the Treasury, the Fed, or the administration, have been reacting to it. In other words, they're acting in a reactive way rather than a proactive way. So they're always behind the eight ball. The Federal Reserve was absolutely too late in acting and initiating liftoff. And they are so far behind the curve trying to play catch up is going to be a difficult task at best, and at worst will be absolutely ineffective.
Gary, let's end the conversation on gold and equities, the equity decline, equity market decline. We've seen in November has been plaguing a lot of investors. You have mentioned to me on several occasions that gold is a hedge against equity volatility, and on a short-term and medium-term basis.
Right.
That certainly seems to be the case in the sense that gold has held up steadily relative to at-risk assets. The S&P 500 has fallen about 16-17% year to date. Gold has not done that badly.
Right.
So from that perspective, it's done quite well. But gold has also not rallied in spite of equity declines. Usually when you think about a hedge, you think about things moving in different directions. If one goes down, the other goes up.
Exactly.
That hasn't really happened this year. Do you still think then that gold is a hedge?
I think that we have a different scenario playing out. We have a new variable, and that variable is real yields on U.S. Treasuries and notes. The market's always forward thinking. They're anticipating what a rate will be 6 months down the road. And so we've seen 30-year bonds, 10-year notes, we've seen them move up aggressively, actually offering a real yield, 2%, 2.5%. That takes a lot of the desire to own gold. Gold is non-interest bearing. It doesn't yield anything. And it also, higher yields result in dollar strength, and then that works against gold. So the reason we don't have that same kind of correlation where if it's a risk-off environment and stocks are going down, then gold's going to go up, because there's an alternative that many believe is safer, more attractive, with a guaranteed return. And that's taken kind of the luster out of gold as a hedge against inflation.
So just on a fundamental and I guess technical basis as well, give us your outlook of gold. It doesn't seem like there's a lot of variables playing in gold's favor right now, but maybe the charts tell differently. Maybe momentum is still on gold's side. What do you think?
My sense is it's obvious that the primary focus of market participants are on rates and where they're going. How high will rates get raised to? And that's taken a lot of the desire to own gold out of the picture, because they're focusing on higher interest rates, which is obviously a bearish component for the price of gold. However, if in fact I'm correct with my assumption that inflation will remain persistent because it is a byproduct of supply chain issues, until that's alleviated, they'll focus upon the rate of interest. However, if in fact they ratchet rates up and inflation stays pretty level, in other words, it's at 8.3 on the CPI, if it goes down to 7%, a small amount, and not say to 4%, investors will shift their focus from looking at the level of interest and look at the non-performance of the tools, and then they will refocus on gold. And I think that's where we would see a pivot.
Give us a price target outlook for gold, medium term.
I say within, by the second quarter of next year, I'm looking for one last leg of the rally, taking gold as high as 2250. That's my target. Timeline,
After that, you told me there's a bear market.
Typically, yeah. After that, we would go into a multi-year correction. How deep that would be is something that we'd have to formulate once we hit a certain price and look at. But that is typically what will follow.